Today's three-stock lunch. Today, we asked our trader to pick three stocks from a CNBC stock screener, looking at some of Wall Street's most overbought stocks, employing the 14-day relative strength index. Here with our trades, Courtney Garcia, Senior Wealth Advisor, Payne Capital Management, CNBC contributor. First up, Courtney, TJX companies, returns of 125% over the past 5 years, up 18% this year. According to our stock screener, its 14-day RSI is a 79, suggesting it is overbought. What's your trade on this one?
Yeah, I would actually be a buyer here of TJX. And the retail space has been really tough because the consumer has remained stretched right now with higher inflation. This is kind of coming across all income cohorts. What's happening is they are willing to spend at the right price and the right inventory level, which is where a TJ Maxx, who's a lower price retailer, is able to benefit. And especially as all of those big retailers have too much inventory right now, this is also something that they can benefit from, where they're able to buy up a lot more inventory right now and pass on that savings to their consumer. So though retail is tough, the reason that retail is actually struggling is all going to benefit something like a TJX. So it's done really well. It just hit some 52-week highs. It also is trading at a premium to its historical averages. But I think in the environment we're in, it's likely going to continue in the short term here. I think it's something you want to make sure you're taking advantage of.
She's taken TJX. What about Walmart? We keep hearing about it. Shares are up 31% this year. The stock screener puts its RSI at 74, so a bit extended. But you heard Simeon Gutman last hour, or Melissa just now talking about how it's category leader. AI can help it. Would you be a buyer?
I would. And Walmart here has been somewhere who typically has not been something for a higher income consumer, but they continue to gain market share in your higher income consumer as they're starting to trade down. So currently about 60% of their sales is groceries, and that's actually what's bringing in a lot of new customer base. But they're really that one-stop shop for all of your goods. And as they're building out their e-commerce business, you're starting to see it more and more of that go across their business. And what I really like about them in the long run is when you look at things like their advertising, things like third-party fulfillment, things like subscriptions, these are higher margin businesses than their core businesses and also growing faster than their core business. So add in things like AI, which can additionally cut costs for them. I think for all of those reasons, it's something that's going to continue to do well over the long run here.
And next up and last on our list of the overbought stocks is Expedia. Stock screener says its 14-day RSI is 74. Your thoughts on Expedia, Court?
Expedia, I'd actually stay away from here, at least in the short term. Some of the things that you're looking at are you're seeing a consumer who is stretched. And when you're looking specifically at travel here in North America, that has actually been lower than expectations. And they're primarily here in North America. So when you're looking to compete with something like a Booking.com's network in Europe, it's going to take a lot of extra spending in order to meet that. And they do have a lot of pros in the long run. I mean, they have a $5 million buyback program. They're cutting costs quite significantly, about $750 million since the pandemic, plus some AI implementation, which should boost that further. But I think short term, some of the headwinds you're seeing when it's travel here in the U.S. and the fact that they're really not yet internationally where they need to be, it's probably going to continue to be there. And it's not yet far enough in the rearview mirror that I'm ready to jump in with two feet.
All right.